June is about continuing to mix growth inflection points with quality infrastructure and doing it across a diversified basket. I'm making 7 stock picks plus adding meaningful exposure to cloud computing through an ETF, because sometimes the best play in a broad theme is equal weighted exposure to the emerging names, not the megacap consensus. So let's start with what's accelerating in AI and biotech. Schrödinger and their drug discovery software. Q1 total revenue came in at 58.6 million, beating estimates by about 20%. Drug discovery revenue itself more than doubled to 22.9 million, up about 124% from 10.2 million last year. It was helped by accelerated recognition of deferred revenue. The company is still unprofitable as it transitions to hosted licensing, but they're launching something called Bunsen. It's an AI co-scientist that autonomously executes molecular discovery workflows, and it's starting this summer. Full-year annual contract value guidance remains 218 to 228 million, 10 to 15% growth. And then there's Avantor, laboratory supplies and services. Q1 adjusted earnings per share of 17 cents beat estimates, with revenue of 1.58 billion, also ahead of consensus, though flat organically. I think this is the classic picks and shovels play on drug discovery acceleration. Schrödinger designs the compounds, Avantor supplies the lab infrastructure and services. Next, I'm looking at Mobileye, Intel's autonomous driving subsidiary. Q1 revenue of 558 million, up 27% year over year. They raised full year 2026 revenue guidance with the midpoint up about 2% and showed solid operating trends. Execution at scale in autonomy remains compelling despite quarterly volatility. For broader cloud computing exposure, I'm going with WCLD, the Wisdom Tree Cloud Computing ETF. It's equally weighted across about 64 holdings, providing diversified exposure to emerging cloud names without mega cap concentration. Top holdings include Datadog, Twilio, Palo Alto Networks, JFrog, and DigitalOcean. Cloud computing growth is not slowing. Spreading capital across the cohort reduces single stock risk. That said, I'm also targeting Adobe specifically. I opened an initial position recently, and now I'm doubling down. Adobe has a strong history of raising guidance, and its software moat remains intact. Earnings are due June 11th. Now, let's mix in quality infrastructure. And I'm also looking at Intertek, a London-listed testing, inspection, and certification company, trading at a forward P/E in the low to mid-20s with consistent earnings power. Next year, EPS forecasts around £2.60 and up. Rising regulatory scrutiny and supply chain verification needs make this a defensive quality name. And then there's my wild card, and I'm going with Aston Martin. Q1 revenue up 16% to £270 million, with gross margin expanding from 28 to 35%, driven by 102 Valhalla supercar deliveries and better pricing and mix. Still unprofitable overall, but operational trends are improving. I think this is a high-risk turnaround that's starting to show momentum. The upside looks asymmetric, but it's very speculative. Finally, Diageo, the spirits giant, trading at a trailing price to earnings of around 19 with a 4% dividend yield. Payout policy targets 30 to 50% with a solid floor. They guided lower on US weakness, pressuring the stock, but premium spirits, emerging market growth, and brand strength offer long-term optionality. Analysts' targets sit around $100. Moving on to the sells, and there's 5 positions that I'm exiting. First, Verizon. The 5.9% dividend yield looks tempting, but I think the growth side is now slowing. Innovation lags and analysts remain neutral. Now rotating to Albemarle, the lithium play. Q1 was strong, sales up 33%, EBITDA more than doubled, lithium prices and EV demand helped, but the stock is up about 37% year to date, near its highs. Lithium is cyclical. Taking some profits on the easy money seems sensible. Then EWZ, the Brazil ETF. Tactical tailwinds from tariff exclusions, but macro risks are rising. Chronic concerns are also resurfacing. I think it's time to rotate into high conviction ideas. Next, Bristol Myers Squibb. Solid execution, but I'd rather own Schrödinger, which is building the AI drug discovery layer, rather than legacy pharma. Also, GILT Satellite. EPS beat, but revenue miss. The stock crashed about 21% post-earnings in mid-May. At a price to earnings of 34, with execution and demand uncertainty, the gap down was a clear signal, so I'm taking some profit. So, that's it for June. Are you finding value in cloud computing ETFs or individual software as a service names? Are any of these stocks on your list? Leave a comment and follow me on eToro as EdWhite1. I'll see you in July.